Imagine waking up to news that the economy is slowing down, businesses are cutting costs, spending is shrinking, and yet the stock market is at an all-time high. Gold prices are breaking, records Bitcoin is surging like it's in a bull run. If money is supposed to be tight, why do asset prices look like a party is in full swing, somewhere behind the headlines? Large sums are moving, quietly flowing into places that most people aren't watching. And those flows are what's really pushing prices higher. When you only follow the headlines, you see the story they want you to see. When you follow the money, you see the moves that shape the future. This is where most investors get it wrong. They react to what they hear on TV, they trust official statements without checking what's actually happening in the numbers, and by the time they realize the truth, the opportunity has already passed. Today's market is not just about interest rates, it's about liquidity. It's about where capital is going when no one is paying attention, and right now that capital is not sitting still. If you can spot where it's headed before the crowd does, you position yourself where growth is born, you step in early, and you avoid chasing prices at the peak. This is what separates the crowd from the ones who consistently build wealth. The crowd waits for confirmation. The smart money moves when things still look uncertain. The question is simple: do you want to follow the noise or follow the money? Most people still think higher interest rates mean the market will fall. They hear central banks say they are tightening, they see the rate number go up, and they assume prices must go down. But that's not how it always works. When liquidity is still flowing into the system, rates can be high on paper, while markets keep climbing in reality. This happens because the official message and the actual movement of money are not the same. A central bank can talk about being strict while quietly increasing its balance sheet. It can use technical tools that most people never notice, and those tools can release huge amounts of cash into the financial system, discount windows, emergency lending programs, special funding facilities. These sound boring, they rarely make headlines, but they act like hidden pipelines of money. When banks or large institutions tap into these programs, billions can move in a matter of days, and that money does not sit idle. It looks for a home. It looks for assets that can rise quickly. Stocks, gold, Bitcoin, even certain real estate markets. These become magnets for the extra cash from the outside. It looks like the economy is roaring back. In reality, the real economy can be cooling. Shops may have fewer customers, factories may be cutting production, jobs may be harder to find. The disconnect between asset prices and everyday life is one of the clearest signs that money is being pumped into assets instead of into production. And if you only watch the headlines, you miss the signal entirely. Following the actual flow of money gives you a very different picture of what's coming next. There was a time when I made the same mistake as most retail investors. I waited for prices to drop. Because I believed high interest rates would crush the market, I kept cash on the sidelines, confident that patience would pay off. While I waited, the market kept climbing. Stocks broke new records. Gold pushed into uncharted territory. Bitcoin exploded past levels no one expected. By the time I realized what was happening, the big move was over. Getting in then meant buying near the top. And that is where losses are born. The lesson was clear. Never rely only on what's being said. Track what's being done. Large institutions don't react to headlines. They react to liquidity. They monitor how much capital is entering or leaving the system. They see where it's going before most people even know it's moving. This is why they can buy when everyone else is selling and sell when everyone else is celebrating. If you want to play the game differently, you have to watch the flows. You have to notice when balance sheets expand, when lending facilities see record use, when capital quietly shifts into risk assets, because the crowd will always move late, and the late movers always pay the highest price. When you walk through a busy city street, you might see restaurants half-empty, shops with fewer customers, and help wanted signs replaced by store closing notices. At the same time, you check your phone and see the stock market breaking records. Gold at all-time highs, Bitcoin surging. The real economy and the asset market are telling two different stories. One shows slowing activity and caution. The other shows excitement and growth. This gap is not an accident. It happens when large amounts of money are directed toward assets instead of production. That money does not build factories. It does not create long-term jobs. It chases quick returns. When this happens, asset prices rise far faster than the economy can justify. The surface looks strong, but underneath the foundation is weak. This is why you can have a bull market in stocks, while small businesses struggle. Why gold can climb while manufacturing contracts. Why Bitcoin can rally while consumer spending falls. It is not about economic health. It is about where the money is flowing. And when you understand that, you stop being surprised by the headline. Big money moves differently than the crowd. It studies where capital is entering the market, it tracks the timing of those inflows, and it positions itself before anyone else notices. Retail investors often focus on price charts and news updates. They react to short-term moves, they follow trends that are already in motion. Institutions watch the sources of liquidity, they see central bank balance sheets grow, they track how much is borrowed from emergency lending facilities, they monitor where ETF flows are going. When they see conditions lining up, they quietly accumulate. Not when prices are in the news every day, but when prices are still ignored or doubted. This is why large funds can sell near the top, because they were buying long before the top existed. It's not about having more resources. It's about following the right signals. If you focus on the money flows instead of the noise, you give yourself a chance to act early, before the rest of the market catches on. Right now, there are 3 types of assets that the biggest players are quietly buying. They are not the hottest names on social media. They are not the ones with the loudest hype. They are the ones with long-term staying power and limited supply. The first is gold. Gold is not new. It has been a store of value for thousands of years. It cannot be printed at will. It is independent of any single government. And in times of uncertainty, it becomes a safe place for capital. Central banks around the world are adding to their gold reserves. Countries like China, Russia, and India are increasing their holdings. This buying is often quiet, but it adds up to record demand, and it supports higher prices over time. The second is Bitcoin. While it started as a niche idea, it has grown into an asset that large funds and even some governments now take seriously. Its fixed supply and decentralized nature make it resistant to inflation and political control. Institutions tend to accumulate during periods of doubt. When the public is distracted or uncertain, and then they benefit when interest returns and prices surge. The third is assets in emerging markets, places with young populations and rising middle classes. Countries like India, Vietnam, and Mexico are becoming production hubs and consumer markets. Early investments in these economies can grow many times over when global attention shifts in their direction. The best prices are available before the story becomes mainstream. These 3 areas, euro, gold, Bitcoin, and emerging market assets, euro, share one thing: smart money enters before the headlines do. By the time the crowd notices, the easy gains are already gone. The reason these assets are being accumulated is not random. Gold and Bitcoin are scarce. They cannot be created in unlimited amounts to meet short-term political needs. That scarcity gives them protection against currency devaluation. Emerging market assets offer a different kind of advantage. Their growth comes from real economic potential, population growth, rising consumer demand, expanding manufacturing capacity. When the global economy shifts, these markets can benefit from supply chain changes and new trade relationships. This creates opportunities that developed markets cannot always match. Large investors understand that interest rates and short-term market swings are temporary, but scarcity and long-term growth trends are lasting. They build positions in these areas while they are still underpriced. They hold through volatility, and they wait for the rest of the world to catch up. By the time the crowd joins in, prices have already moved far from where the smart money bought in. This is why patience and early positioning matter more than reacting to headlines. Following this approach does not require predicting every market move. It requires identifying where the big players are focusing and moving quietly in the same direction before attention floods in. Positioning early also means resisting the urge to chase when prices are climbing fast and headlines are everywhere. That is often the time when the biggest gains are already behind you. Smart money buys when things are quiet, when an asset is out of the spotlight, when sentiment is mixed and confidence is low. This applies to gold before a breakout, to Bitcoin before a bull cycle starts, and to emerging markets before major foreign investment flows in. The crowd often does the opposite. They sell when conditions are uncertain and prices are flat. They buy when excitement is high and risk is rising. This pattern repeats across decades and in every type of market. The key difference is not information, it is discipline. By focusing on money flows and fundamentals, you can take position without being pulled by emotion. You can hold through noise and avoid overpaying at the peak. Ita Euro Sips. Not about timing the exact top or bottom Ita. Euro Sips about entering in a range where the odds are in your favor, and then letting time and trend do the work. Risk management is just as important as spotting opportunities. Even the best assets can experience sharp drops without a plan. A temporary dip can turn into a permanent loss. Avoid using heavy leverage when building positions. Borrowed money magnifies losses. A small market pullback can trigger forced selling and wipe out gains. Decide in advance how much of your portfolio each asset will take. Spread risk across different areas. Balance between defensive holdings like gold and growth-focused positions like emerging market equities or Bitcoin. Have clear points where you will review your position, not based on panic, but on whether the original reasons for buying still exist. Be ready for volatility. The path to long-term returns often includes periods of sharp movement. Those who prepare for them can hold through. Those who don't are forced out at the worst time. The goal is to survive market swings without losing the ability to act on the next opportunity. This is how you compound over years instead of chasing short bursts of luck. If you want to think like the smart money, start by tracking the actual flow of capital. Look at central bank balance sheets. Monitor the use of lending facilities. Watch where ETF inflows are going. Use reliable data sources, not just opinion pieces or news commentary. Numbers reveal movement before narratives do. Build the habit of checking these signals regularly. When you see liquidity expanding, expect risk assets to respond. When you see liquidity contracting, expect pressure on prices. This approach removes guesswork. It shifts focus from short-term noise to the underlying fuel that drives markets. Once you identify where the money is heading, plan your entry before the crowd scale in slowly and prepare to hold through the early quiet phase. By the time the majority catches on, you will already be positioned. You won't need to chase. You will be in a place to decide whether to take profits or continue holding based on your original strategy. The passive path is about building wealth step by step. It is about moving early, holding with conviction, and protecting your position from unnecessary risk. A simple action plan can keep you aligned with this approach. First, decide the percentage of your portfolio you want in defensive assets like gold. Second, choose your allocation to growth opportunities like emerging markets. Bitcoin. Third, track money flows monthly and adjust if the direction changes. Do not wait for a perfect moment that never comes. Begin with small, steady moves. Add when conditions favor your plan. Pause when signals weaken, but keep your long-term vision intact. The investors who succeed are not the ones who guess every market turn. They are the ones who stay prepared and act before the crowd. Like and subscribe to The Passive Path to keep learning strategies that help you see beyond the headlines. Comment with which of the 3 assets you would start accumulating today and why. Follow the money, not the noise. That is how you position yourself for lasting growth. Share this video with someone you care about so they can make better decisions too. I wish you the best in your investing journey. Feel free to explore other videos on this channel for more strategies and insights. I'll see you in the next video.